What is QSBS? QSBS allows you to avoid capital gains taxes on your equity in startups or small businesses by this definition. Most of the small businesses that QSBS refers to are technology startups. There are some other exceptions, but that's kind of really where the focus will be today. Now, historically, your ability to avoid capital gains taxes is either the greater of $10 million or 10x your basis in the company. We'll ignore the 10x your basis for right now. What that practically means is each individual, so whether that's an individual or a non-grantor trust or another type of trust, can avoid, if you have $10 million of shares in what was a startup, you've held it for 5 years, it meets a few other qualifications, you can avoid $10 million in taxes. Now, that limit got increased to $15 million. So what that meant is if you start your company after this bill comes into play, you can individually avoid up to $15 million. You can avoid taxes on $15 million of QSBS. Now, the critical part is it's going to take some time to come into play because you have to start your company after the deadline and you have to hold those shares for 5 years to be able to avoid the full $15 million exemption. But the second part of this benefit is that historically QSBS, there was a cliff. You didn't get any QSBS benefits unless you held your shares for 5 years. Now the really attractive opportunity is you start to get partial benefits earlier. So starting at 3 years. So this means if you've held your shares for 3 years, whether it's you've been an employee in you've held your shares for 3 years, or you're an investor, you can avoid 50% of the taxes, of the capital gains taxes, up to $15 million per entity. Now, at year 4, it's 75%. And so what this means is, hey, not only can you avoid taxes on a larger amount, going from 10 to 15 million, but you can also start to do that earlier and get tax benefits. And this is, if you think about from why this makes the startup ecosystem more attractive, is I can tell you, we have conversations every day with early employees, founders, and candidly, it's like when they're looking at this, they're looking at the exit and being able to say, hey, if you can avoid 100% of the taxes, first of all, there's no better tax benefit out there. This makes it attractive. This is part of people's calculus when they decide to sell a company. And so when you start to say, hey, you can avoid taxes on a larger amount, or you can start getting some of those tax benefits earlier, it will change the calculus. So we'll see more sales, more capital investment. The throughput of capital is going to increase, which makes it more attractive from a capital allocation standpoint as well.
And I think just to add, kind of from the perspective of the individuals that we work with, it's kind of taking a step down from that kind of policy orientation, which is totally correct. Where I think this really matters is we talk to founders and early employees all the time who are considering taking money off the table, taking advantage of their early success, and who are wary of doing that at year 3 because they're not QSBS eligible yet. They realize that if they hold, they're gonna move. Yeah. They're gonna hold on until year 5 just to get over that cliff. Now all of a sudden, taking secondaries in year 3.5 might make a lot more sense, and that means, as Monty said, that unlocks a lot of deals. It also just means that individuals are going to be better able to take advantage of the value that they've produced, that they've created, which is
yeah. And one of the interesting things is, one, the size of the startup ecosystem has expanded tremendously. We expect this to continue. We're starting to see alternative forms of financing, larger pools of capital, and this is reflective in the increase from 10 to 15 million. The value of these companies, if you look at the top of publicly listed companies, it's mostly tech companies. 20 years ago, 40 years ago, that wasn't true. It was industrials. The reality is now economic value is mostly derived by what we deem as tech companies today. And so that's going to continue, and it's going to make this early stage system more attractive. The other piece we're seeing is small businesses. I'm going to colloquially call these startups. They used to be defined where you could get the tax benefits if you received the equity or exercised the equity when the company had up to 50 million in assets. That also increased 50%. So now you're a quote unquote startup or small business that qualifies for QSBS, you have less than $75 million in assets. So what does this practically mean for startups out there that start is, one is QSBS is more valuable. Each person who has equity can avoid up to $15 million of taxes on capital gains before they do QSBS stacking and multiply that. More employees, more investors will qualify because before, if they invested or got equity when the company had 60 million in assets, they didn't qualify. Guess what? Now they do. And typically at those stages, you have more employees, more investors. So the pool of people that will benefit from this is more attractive. And this also makes it more attractive to larger uh, allocators because those folks typically have, it's not worth their time to invest $1 million or $2 million. But these later things where the company's worth closer to 75 million, it may be worth their time to put capital in. And these tax benefits may increase their allocation to the space.
And so I think the upshot, Monty, then is that gets at least marginally easier to raise money, and also marginally easier at least to hire and to incentivize folks to join. Right? If I can tell someone that we're looking to hire that in the old world their equity would have been worth what it's worth, but they wouldn't have been tax free, and now all of a sudden we've raised X dollars and we're in that gap between 50 and 75, and I can tell you if you exercise today, your equity is going to be QSBS eligible, and by the way, more of it and earlier. All of a sudden, that equity offer just became a lot more valuable.
Yeah, I wish I'd been able to put it as succinctly as that, but equity in startups just got a lot more valuable. Right. And that means investors, employees, founders, everyone is going to benefit from that. And that means we should see more people, our best and brightest, continue to go into this space.
And so